Wealth isn't about luck or guesswork. It's about making mathematically sound decisions that compound over time. While social media often promotes flashy, get-rich-quick schemes, the real path to financial growth lies in understanding the numbers behind big purchases. The most successful wealth builders use mathematical principles such as compound interest, return on investment calculations, and leverage to guide their decisions. These following 5 purchases, backed by decades of financial data and mathematical analysis, offer the highest probability of increasing your net worth over time. Each recommendation is grounded in verifiable statistics and proven formulas that have created wealth for millions of Americans. 1. Index funds and ETFs. Let compounding work its magic. Index and exchange-traded funds represent one of the most mathematically sound approaches to wealth building for individual investors. These investment vehicles track broad market indices like the S&P 500, providing instant diversification across hundreds or thousands of companies with a single purchase. The mathematical advantage becomes clear when examining historical performance data. The S&P 500 has delivered an average annual return of approximately 10% over the past century, or about 7%, after adjusting for inflation. This consistency allows investors to harness the power of compounding through the formula A equals P, 1 plus R, caret T, where your initial investment grows exponentially over time. Consider an investor who contributes $500 monthly to a low-cost index fund earning 7% annually. After 30 years, this disciplined approach would result in contributions totaling $180,000, but the final account value would exceed $600,000 due to compound growth. The difference of over $400,000 represents the mathematical power of consistent investing in diversified market exposure. Expense ratios play a crucial role in this equation. Low-cost index funds like Vanguard's total stock market ETF charge expense ratios as low as 0.03% annually, while actively managed funds often charge 0.5% to 1% or more. Over decades, this difference in fees can cost investors tens of thousands of dollars. A $100,000 investment growing at 7% annually for 30 years would be worth approximately $50,000 less with a 1% expense ratio compared to a 0.03% ratio. The key to success lies in consistent investing regardless of market conditions. This strategy, known as dollar cost averaging, mathematically reduces the impact of market volatility on your average purchase price. 2. Real estate. Leverage your way to long-term appreciation. Real estate offers a unique mathematical advantage through leverage, the ability to control a significant asset with a relatively small down payment. This amplifies the potential returns and the mathematical impact of property appreciation over time. Historically, U.S. residential real estate has appreciated at an average rate of 3 to 4% annually over long periods. While this may seem modest compared to stock market returns, leverage transforms this growth rate dramatically. When you purchase a $300,000 home with a 20% down payment of $60,000, you control the entire asset's appreciation potential with just 1/5 of its value. If the property appreciates at 4% annually, it would be worth approximately $650,000 after 20 years. However, your actual return must account for mortgage payments, property taxes, insurance, and maintenance costs over those 20 years. Even after paying these ongoing expenses, typically totaling $2,000 to $3,000 monthly, including the mortgage payment, your initial $60,000 down payment would control an asset that gained $350,000 in value. This leveraged appreciation, combined with mortgage principal paydown, often outperforms what the same $60,000 would have earned in other investments, though the total cash invested over 20 years is substantially higher. The mathematics becomes even more compelling when rental income is factored into the equation. A property generating $2,000 monthly rent on a $300,000 purchase price provides a gross rental yield of 8% annually before expenses. The cash flow can cover mortgage payments while building equity even after accounting for property taxes, insurance, maintenance, and vacancy periods, typically totaling 30 to 40% of rental income. Location remains critical to this mathematical equation. Properties in areas with strong job growth, limited housing supply, and desirable amenities tend to appreciate faster than the national average. In contrast, properties in declining regions may not keep pace with inflation. 3. Education and skills training. Invest in your highest returning asset. When calculated over a career span, the return on investment for education and skills training often surpasses traditional investments. The key lies in targeting skills that command significant salary premiums in the marketplace. Technology skills consistently demonstrate exceptional ROI potential. A $15,000 coding boot camp might enable a career transition from a $40,000 annual salary to $70,000 or higher. Over a 20-year career, this $30,000 annual increase totals $600,000 in additional lifetime earnings, creating an ROI of 4,000% on the initial investment. Professional certifications in high-demand fields offer similar mathematical advantages. Project management certifications, cloud computing credentials, and specialized trade licenses often cost between $1,000 and $5,000 but can increase earning potential by $10,000 to $20,000 annually. The ROI calculation for education follows the formula: lifetime additional earnings, cost of education, / cost of education times 100. This mathematical framework helps identify which educational investments offer the highest returns. Beyond direct salary increases, enhanced skills often provide additional financial benefits, including job security, promotion opportunities, and the ability to negotiate better compensation packages. These indirect benefits compound the mathematical advantage of educational investments over time. 4. Personal finance books, small investment, massive decision-making ROI. The mathematical impact of financial education through books creates one of the highest return on investment opportunities. A $25 book that prevents a single poor financial decision can generate returns in the thousands of %. Consider the cost of financial mistakes, choosing high-fee investment products, carrying high-interest debt unnecessarily, or missing tax optimization opportunities. A quality personal finance book that helps you avoid transferring a $5,000 credit card balance to a lower interest option effectively provides a 20,000% return on a $25 investment in the first year alone. The compound effect of better financial decision-making extends throughout your lifetime. Understanding asset allocation, the impact of expense ratios, and tax-advantaged account strategies can improve investment returns by 1 to 2% annually. Over 30 years, this seemingly slight improvement can result in portfolio values that are 30 to 50% higher than they would have been otherwise. Books on investing fundamentals teach concepts that scale with your wealth. Learning about the power of compounding, diversification, and risk management becomes more valuable as your investment amounts increase. A lesson that saves you 0.5% in fees annually becomes worth $500 on a $100,000 and $5,000 on a $1 million portfolio. The mathematical beauty of financial education lies in its scalability. The knowledge that helps you optimize a $1,000 investment equally applies to managing $100,000 or more. 5. Cash flowing assets. Build passive income streams that scale. Cash flowing assets represent the mathematical pinnacle of wealth building because they generate ongoing income while potentially appreciating. These assets work continuously to increase your net worth, creating a compounding effect beyond simple capital appreciation. Real estate investment trusts provide accessible exposure to cash flowing real estate without direct property management. Quality REITs have historically provided dividend yields between 4 to 6% annually while offering the potential for capital appreciation. A $10,000 REIT investment yielding 5% generates $500 in annual passive income, which can be reinvested to purchase additional shares and compound returns over time. Dividend-paying stocks offer another mathematically sound approach to cash flow generation. Companies with long histories of consistent dividend payments and growth often provide yields of 2 to 4% annually, with many increasing their dividends annually. This creates a mathematical snowball effect where the dividend amount and the underlying stock value tend to grow over time. Small businesses can provide exceptional cash-on-cash returns for those willing to invest time and capital. Service businesses like laundromats, car washes, vending machines, or storage facilities often generate 15 to 25% annual cash flows on invested capital, though they require more active management than securities investments. The mathematical advantage of cash-flowing assets lies in their dual benefit structure: regular income that can be reinvested for compound growth plus potential appreciation of the underlying asset value. Conclusion: mathematical principles provide a clear roadmap to wealth building through strategic purchases that compound over time. These 5 categories: index funds, real estate, education, financial knowledge, and cash-flowing assets, each offer proven mathematical advantages backed by decades of performance data. The key to success lies not in timing markets or finding secret strategies, but in understanding the numbers behind these wealth-building tools and applying them consistently over long periods. Start with one area that matches your current financial situation and risk tolerance, then gradually diversify across multiple wealth-building strategies as your knowledge and capital grow.